Topic 7 is about credit reports. What is a credit report? A credit report is a detailed record of your financial history and includes details about your payment history, credit, and other information. Lenders often use your credit report to decide whether they should give you a loan and the terms of the loan, such as interest rate. They are less likely to loan to someone who has late or missed payments, mortgage defaults, or bankruptcies, which are all shown on your credit report. If you would like to check your credit report, you can request one for free every year, and there are 3 ways to do so. The first method, which I would recommend, is to go to annualcreditreport.com to request a credit report online. But you can also choose to request over the phone or by mailing a filled-out annual credit report request form, which you can find online. Currently, the 3 largest credit bureaus in America, Equifax, TransUnion, and Experian, now allow you to access your credit report for free every week through annualcreditreport.com. So I would highly encourage you to regularly check your credit report for any errors. If you do encounter an error, here's how you can dispute the error with your credit agency. Many credit bureaus have dispute forms, which you can fill out. The process can vary depending on the organization, so be sure to contact them or check their website for details on their process. If your credit bureau does not have a dispute form or specific process for disputing errors, you can contact them directly by sending an email or letter. On the right, I've included a sample letter template from the Federal Trade Commission to help you draft your letter or email. Topic 8 is all about credit scores. What is a credit score? A credit score is a numeric rating that assesses a person's credit risk based on information in their credit report. To put it simply, a credit score is a number that measures how good your credit report is. The most common scoring system we use in the US is the FICO scoring system, which is a system that grades your credit report from a scale of 300 to 850 based on 5 categories. The category that is 35%, the largest percent of your FICO score, is your payment history, because lenders want to know whether you have paid past credit accounts on time. The second largest category, which is 30% of your score, is the amounts owed. If you use a lot of your available credit, this may indicate to lenders that you are at a risk of defaulting, essentially not being able to repay them. 15% of your score is the length of your credit history. Managing credit for a long time shows that you are more reliable with credit and improves your credit score. The last 2 categories that each make up 10% of your score are new credit and credit mix. Credit mix is simply a mix of the different types of credit you use, including credit cards, retail accounts, installment loans, finance company accounts, mortgage loans, and more. The new credit category keeps track of how often you open new accounts. Avoid opening several new credit accounts within a short period of time because this shows lenders that you may be a high-risk borrower. A good credit score is generally considered to be above 650. If you have a good credit score, lenders are more likely to lend to you and offer higher interest rates. There are many ways to increase your credit score. The most important way to keep a good credit score is simply to pay your bills on time. You should also try to keep your credit balance low. Your credit utilization rate is the amount of credit you spend compared to the amount you have available. It is good to have a credit utilization rate below 30%. And it's even better to have a credit utilization rate below 10%. Another tip is to keep your old accounts active. They contribute to your available credit, keeping your credit utilization rate low. And they also contribute to the length of your credit history, which, as mentioned before, is 15% of your FICO score. If you have a credit card you no longer use, try to use it every few months just to keep it active. If you want to reduce the fees, you can contact your card issuer to downgrade your credit card. Topic 9 is all about who uses your credit report and score. Aside from lenders, landlords can use your credit report to assess the likelihood that you will be a reliable tenant and pay your rent on time. Potential employers can use your credit report to verify your identity, gauge your money management ability, and your reliability overall. Insurance companies use your credit report and credit score to determine your insurance rate. Those with higher scores will likely have lower insurance rates, while those with lower scores will likely have higher insurance rates. Having a good credit score comes with many benefits, including lower interest rates on big purchases, higher chances of qualifying for credit, higher chances for renting a home, lower insurance rates, improved credit card rewards and limits, favorable terms for utilities, and much more. And if anybody wants to check your credit file, they'll first have to make a credit inquiry. And there are 2 types of credit inquiries, a hard inquiry and a soft inquiry. Hard inquiries are when a creditor accesses your credit file to assess your creditworthiness to approve you for a credit card, loan, or line of credit. They typically occur when you apply for credit, and they do require your permission. They temporarily lower your credit score and remain on your credit report for 2 years. Soft inquiries are when anyone, including yourself, checks your credit file for any reason unrelated to lending money. They may occur for a variety of reasons and may not always require your permission. Unlike hard inquiries, they don't affect your credit score, but like hard inquiries, they do remain on your credit reports for 2 years. Topic 10 is about debt management. Repaying all of your loans is very important because failing to repay them can have serious consequences. Failing to repay a loan will lower your credit score, making it more difficult to secure favorable loan terms. Lenders will also likely charge higher interest rates. Landlords, insurance companies, and potential employers will also check your credit report and credit score, and failing to pay debts will reflect negatively on reliability, which can limit your housing options, increase insurance premiums, and hinder your job searches. If you are struggling to pay off your debts, credit counseling is a good resource for seeking assistance. Credit counselors offer advice on budgeting and saving money to pay off debts. Most reputable credit counseling companies are nonprofit and offer their services at low prices. Credit counseling may offer debt management plans, debt settlements, or another solution to your debt problems depending on your situation. However, if you seek credit counseling, scams are very common, so try to avoid them. Since not all credit counseling companies are legitimate and many may try to charge higher fees that they don't tell you about, make sure to do background research on credit counseling companies to ensure their legitimacy. If your credit counselor suggests a particular plan before thoroughly reviewing your finances, this is a sign that they may be trying to scam you, so be wary of that. When choosing between nonprofit and for-profit credit counseling, be aware of the costs and benefits to decide which is best for your situation. Nonprofit credit counseling services will usually try to negotiate with creditors to reduce your amount of debt. Many provide free advice and services to help pay off debts. They can definitely help reduce costs of debt, however, there are many illegitimate companies that may try to scam you. For-profit counseling services will also try to negotiate with creditors to reduce your amount of debt and can sometimes reduce your debt significantly. However, they often charge high service fees, and some lenders refuse to negotiate with for-profit credit counseling services. Topic 11 is about bankruptcy. So what are bankruptcy laws? Bankruptcy laws allow debtors to have a fresh start from debts they are unable to pay off. However, this fresh start doesn't simply erase your debt, and it comes with significant effects. You will likely have to sell off assets to pay off a portion of your debt. Bankruptcy will also ruin your credit score, which will take some time to rebuild. This will still likely prevent you from accessing new credit after filing for bankruptcy until you can rebuild your credit score. Bankruptcy can also affect your ability to find employment, but it will not affect your current employment, since employers cannot legally fire you or change the terms of your employment because of your bankruptcy. However, you can still be fired for other reasons unrelated to your bankruptcy. If you are unemployed or seeking new employment, bankruptcies can affect job applications. Although federal, state, and local government agencies are not legally allowed to consider your bankruptcy when hiring you, private employers can. Private employers are allowed to look at your bankruptcy when considering your job applications, which can affect your chances at gaining future employment. If you are struggling to pay off your debts and must resort to bankruptcy, the two most common types of bankruptcy are Chapter 7 and Chapter 13 bankruptcies. Chapter 7, also known as liquidation, bankruptcy involves selling off some of your assets to pay off what you can of your debt and discharging the rest of your debt. The court will assign a trustee to your case to help manage the assets you sell and pay back the creditors with the proceeds. In order to qualify for this type of bankruptcy, you must pass a means test or meet certain criteria for low income. Chapter 13, also known as reorganization bankruptcy, involves restructuring your debt with a plan that allows you to pay off a portion or all of your debt over a period of 3 to 5 years. You will have a monthly payment plan, which you can negotiate with your creditors. You get to keep your assets, and a means test is not required for a Chapter 13 bankruptcy, but there are still some requirements before you can file for this type of bankruptcy. Topic 12 is about consumer credit protection. What are consumer credit protection laws? Consumer credit protection laws govern disclosure of credit terms, discrimination in borrowing, and debt collection practices. Consumer credit protection laws ensure people can make informed decisions with their credit. Some important laws include the Truth in Lending Act, the Fair Credit Reporting Act, the Fair Debt Collection Practices Act, and the Consumer Credit Protection Act, among many other laws that protect your credit. These laws try to prevent discrimination and abusive practices, such as predatory lending. Predatory lending is when the lender tries to take advantage of the borrower with unethical means. They impose unfair and often deceptive loan terms. that have high fees and interest rates, strip the borrower of their equity, or give a lower credit-rated and more expensive loan. Predatory lending typically targets vulnerable populations, including those struggling to meet expenses, people who have recently lost jobs, and those denied access to a wider range of credit options, often due to illegal discrimination. I highly encourage you to do some of your own research on your credit rights and responsibilities to help you make informed financial decisions. And some great sources with up-to-date information on this topic include the Consumer Financial Protection Bureau, the Federal Trade Commission, and reliable credit bureaus including Equifax, TransUnion, and Experian. Topic 13 is about alternative financial services. Alternative financial services, commonly abbreviated as AFS, are products and services offered outside of traditional banking institutions. Some alternative financial services include cash checking outlets, money transmitters, pawnshop loans, car title lenders, and payday loans. Cash checking services allow people to cash checks instantly without a bank account and often include a fee. Money transmitters are companies or individuals that facilitate the transfer of funds between individuals. Some money transmitters that you may already know of are PayPal and Venmo. Pawnshop loans are offered to people in exchange for an item. The loan offered is often only a % of the item's actual resale value. Car title lenders loan money and take ownership of their borrower's car as collateral. Payday loans are a short-term, high-cost loan due on the borrower's next payday. Alternative financial services come with a few benefits and costs compared to services from traditional banking institutions. They have faster approval processes and more lenient eligibility criteria. However, they often have either high interest rates, fees, or revenue-sharing arrangements. Payday loans are a very commonly used alternative financial service because they are easy and efficient to use and provide quick relief from financial struggles. But when someone relies on payday loans to relieve their financial strain, they often end up in a cycle of debt because payday loans come with a very high interest or fees. The interest and extra fees increase people's financial strain, making them even more reliant on payday loans, which they use to pay off their previous loans. This leads to a cycle of continuous reliance on payday loans as their fees and debt pile up, increasing their financial strain. So be careful when taking a payday loan and avoid getting stuck in a cycle of debt.